So I want to start this week's show by talking about an alternative to the 4% rule. So the 4% rule was created by Bill Bengen, a couple of decades ago, and it's a rule of thumb that's used to provide a sustainable retirement income. So it's often applied to pensions. So the idea behind it is that if you withdraw 4% from your portfolio as a starting point, so let's just say, for argument's sake, you have £1 million in a pension pot. If you were to take 4% in the first year, so that would be £40,000, you then each year increase that fixed £40,000 by inflation, and as that goes along, that should give you each year an inflation protected income stream, but also that should be sustainable up to 30 years. So that was the original idea of the research. So you should be able to get a sustainable income that could last 30 years. It means you wouldn't run out of money. Now, we did do a podcast piece, episode 210 of the Money to the Masses podcast, where we looked at debunking that rule. So the results of that were, broadly speaking, that the 4% rule assumes that you're going to have 50% shares and 50% treasuries. So you're looking at 50% equities, 50% fixed income, and it would produce that sustainable income stream that increases with inflation over time. Subsequent analysis shows that actually a more sustainable rate is somewhere between 1.7% and 3.6%. But if you want to have a 90% chance of not running out of money at all in retirement, then you need to look at something like 1.8% as the starting point for withdrawals. So that is one method, but there is an alternative method. If you are looking at periods like we had during the pandemic when the markets crashed, say 20%, that's what we saw in most equity markets. The problem with the 4% rule is that during periods where we have market volatility, if the portfolio falls, then you are taking, in my example, I said £40,000 to start with, which is increasing over time with inflation. Technically, it can decrease if inflation falls and it actually becomes negative, so we get a bout of deflation. But if you keep taking that fixed amount that's slowly increasing, when the market falls and your portfolio falls in value, then you're taking a bigger percentage chunk, and therefore that means that your money is more likely to run out over time and it won't last your whole retirement, for example. So that is an issue with that 4% rule or variations of it. An alternative is to take a fixed percentage. So this takes into account market fluctuation. So let's say you took 4% every year. So if your portfolio went up, you took 4% of that new value of your portfolio. So therefore it could increase. Let's just say your portfolio, after taking money out after year one, increased by 10%. Let's just being optimistic here. So 1 million goes to 1,100,000. That would mean that your second year income will increase to 4%, which is £44,000 in year two. Equally, if the market value was to fall of your portfolio, then you would take less than the £40,000 you took in year one. So by doing that, you would never run out of money because you're always just taking a percentage. But the reality is, for people who want an income stream, such volatility in their income stream isn't useful, because most people have costs that are relatively fixed and that increase over time. So that's why people would like the 4% rule. But there is another alternative that exists, and Vanguard did some research that relates to this alternative dynamic spending method. And what I wanted to do today was to look at that spending method, particularly in relation to the pandemic, because Vanguard did a new white paper about this dynamic spending method in relation to the market slump that we had during the pandemic. So how dynamic spending works, it varies the amount that you spend each year because it has some reference to what's going on in markets. Now, if you use a spreadsheet, you can start to use that to work out some of the numbers. And if you're listening to this as a podcast, an audio only podcast, then I have created a YouTube video which will be up in time where I do show some numbers on screen. So if you find the numbers a bit mind-boggling when you listen to it, then do keep an eye out for that video, because it will be up and it will show you the numbers. But I am going to give you a tool later on that exists that you can use to work out numbers yourself. So dynamic spending works by taking a portfolio size at the start, and I'm going to just assume £1 million because it makes the numbers easy. So under the usual 4% rule, then what would happen is you would have spent, if I assume 4%, you would have spent £40,000 a year. And in year two, if we assumed an inflation rate that year of 2%, then your spending in year 2 would go up to £40,800, irrespective of what your portfolio was doing, whether it gone up or down. And of course, that's where you can get that sequence of event risk, where you can have markets go down and you take a large amount of money from your portfolio. It's a fixed amount, but percentage-wise, it can be significant, and that can then impact the sustainability of your income stream into retirement. So that 4% rule of £40,000, yes, it's inflation protected over time. Now, if you were doing the fixed percentage of just 4% every year, whatever your portfolio is valued at, so you start at £40,000 in year 1. If your portfolio grows to £1,100,000, then you've got £44,000 in year 2. But if you change the numbers, and if, let's say for example, you had the portfolio drop to £900,000 in year 2, then what would happen is your fixed percentage of 4% would equate to £36,000 as your income in year 2. So that's a significant drop. So most people wouldn't want that kind of volatility because it reflects the volatility you're seeing in markets. But if instead you use a dynamic spending rule, the way it works is it gives a ceiling and a floor to the amount that you can take out in a year, and that ceiling and floor number that you calculate is with reference to your portfolio size, so what's going on in markets. Now, I'm going to tell you the numbers, so like I say, you might have to pause things and re-listen to it to get the numbers in your head. But what you do in order to work out the spending under a dynamic spending system is that you take the amount that you would have got under the 4% rule. So do you remember when we were talking about it, you'd have the 4% rule. You take £40,000 in my example in year 1, it would increase with inflation of 2%, I'm assuming, to £40,800. That's your starting point. What you then do is you then create the ceiling number, so that's a maximum you can take, and you use, this is Vanguard's numbers that I've looked at in the white paper, which we will put links to in the notes of this episode. The 5% ceiling, so you add 5% to that number, so 5% on top of that 40,800, that gives you this ceiling of £42,840. The floor, in the paper that I looked at, Vanguard used a floor that was 1.5% below that 40,800 number. So there are other papers I've seen when they use 2.5%. But if you use that number of a floor, what it means is that even if your portfolio tumbles in value, then the minimum that you can take or will take is £40,188. So you can see that it's with a reference point of the 4% rule number, but it gives you a higher amount if your portfolio does very well, but it gives you a lower amount if the portfolio drops in value. But unlike the fixed percentage version, where you're literally taking a fixed percentage of your portfolio, what the dynamic version does is it does that, but it limits the amount that you can take if your portfolio does well. So it keeps some money in the pot that can help you in the future to maintain that income stream. But if your portfolio drops, it reduces your income slightly, but it means your portfolio again will be more likely to produce a sustainable income stream in the future. So you've got the ceiling and the floor. So all you've got to think about, there's two boundaries. And then what you do to calculate what your possible year 2 spending number is, you take the fixed percentage rule that you were using. So that's the one where you just take a 4% of whatever the portfolio is. Then if that's your percentage 4, then if the portfolio has gone up to 1.1 million, I said, then that percentage of 4% is 44,000, and you look at the ceiling and the floor, and if it's between those numbers, then great. If it's not, then you would take either the ceiling or the floor. So in this example, £44,000 would have been the amount you would have taken, but the ceiling that I've calculated is £42,840. So that means that's the most I will take. Now, I'm going to tell you how you calculate ceilings more easily, because I've just given you an example there. And as I say, I've run some numbers that people can see if they watch the YouTube version of this. But the key message is that this dynamic spending rule, what it's really doing is getting a bit of best of both worlds. So it's taking the idea that you might be able to get more if your portfolio is doing well and increase the amount you take, but not unsustainably. But if your portfolio falls, it's actually reducing it, but it's not reducing it unrealistically. So you don't have wild swings in the amount that you get each year. There's an element of stability that's going on. So what is interesting is Vanguard then took the idea and they looked at it with reference to what was going on in the post-pandemic period. And there's a paper that we'll link to which you can read through at your own leisure. And they looked at the impact of using different methods. So they put aside the fixed percentage method. They just looked at, in particular, the dynamic version and the 4% rule that we all know. And if you go and look at the numbers that they crunched, they looked at the market expected return. So this is something Vanguard does. It looks at the potential returns for different assets that they assume in a portfolio. Now, you've got to think that when the market crashes, then the expected future returns of those assets after a crash actually goes up slightly. So if you think about it, it's almost getting something on sale that if you see the market drop, it becomes good value. Your expected annual return in the future can increase because you've gone from a higher price to a lower price. And if things fundamentally pick up, it does tend to suggest that you will see a dynamic where that expected return goes up. So it takes all that into account. What you need to focus on is that in their paper, they worked out that if somebody had £1 million, they say dollars, but it doesn't really matter, $1 million, and they have an asset mix that is broadly 50-50, so 50% equity, 50% bonds, then you would have an income stream before the pandemic which was sustainable of $52,000. Now, if you just use the old style 4% rule where it increases slightly with inflation each year, the sustainable amount was £45,000. Now, after the crisis, they took into account the changes in valuations, like I said, and the expected returns for assets going into the future. So they worked out that after the pandemic, taking into account to changes in expected returns of different assets, they worked out that the sustainable base case, this is, for dynamic spending, that method of fluctuating your annual income within limits, that sustainable amount had dropped to 45,600. So it's gone from 52,000 down to 45,600 a year. Now, under the 4% rule where your amount goes up with inflation each year, then that had dropped because of the pandemic from £45,000 a year as a sustainable income to 40,800. Now, they then looked at other variations and scenarios of the most likely, looking at the optimistic outcomes and the pessimistic outcomes. But what it really is, the takeaway on this is that the dynamic spending method allows you to take more up front as a starting income. So following a crisis like we had with the pandemic, the sustainable income levels under each method, it remains higher under that dynamic spending method that Vanguard likes. So the numbers are available in the white paper, which we'll put a link to. They also looked at the percentage chances that you would have money when you get to later in retirement. So let's look at the probability of success in times of crisis. They looked at that with a dynamic spending method, you'd have a 91.4% chance of having some money left over after a 30-year period. That compared to 65.8% when you use the normal 4% rule. That was before the pandemic. After the pandemic, with a whole range of assumptions, then that had dropped to a 66.2% success rate for dynamic spending and also 35.8% for the 4% rule method. And those assumptions in that were that you wanted $50,000 a year, so £50,000, and you wanted it to last 30 years. So what was the chance you had money left over? You can find the full information if you want to via the link in the notes. So the big takeaway from this part of the podcast, there are other methods other than the 4% rule and ways that you can dynamically change your spending to make your money more likely to last longer and actually give you a slightly higher income at the start. Now, this is all based, of course, on various assumptions that you can see in the notes if you want to look at them. And, of course, history doesn't always repeat. And that's one of the things. You look at the 4% rule, people have looked at that and debunked it. People will look at this research. Has it been applied to historical cases? All historical cases, there will be people who will pick holes in it. But what it does do is it gives you an alternative method. Now, There are people who are going to be listening to all that and say, I like the idea of having these limits. How do you work them out? Fortunately, there is an app, a website called ficalc.app, which you can find. Put a link again in the notes, and it will do various different calculations, different methods. So you can go on there, put in your own numbers, your own term, whether you want to use the 4% rule, whether you want to use, for example, the dynamic spending rule that Vanguard talks about. You can use it and it will work out all of the numbers for you, so it will give you something to work with. So play around with it, have a look at what it produces. Obviously, you've got to just take it with a slight bit of pinch of salt, really, because it isn't anyway guaranteed, but it will give you something that you can work with. And of course, don't forget there are other alternatives. For example, you can just live off the yield of your portfolio rather than taking chunks of it at a time. So let's say, for example, you have a portfolio of shares or equity income funds. They can produce an income stream that can keep pace with inflation. It needs a lot of research because obviously you've got to look at good, reliable dividend payers or funds that have a reliable history of paying out money, income year on year. That would obviously mean look at investment trusts. We do a lot of research on that on 80/20 Investor. Of course, we'll put links to that in the show notes so you can take out a free trial if you wish to. So there you go, an alternative and interesting method of providing a sustainable income from investments and pensions.